On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. Oh, welcome to the On the Tape podcast. Guy Adami, Dan Nathan, Danny Moses, back from Miami Beach, Florida. It was a great trip. iConnections conference. I thought last year was good. Whoa, Nelly. That's Keith Jackson, by the way.
There, yeah.
This year was, what did kids say?
It was fire. Straight fire.
Off the chain or something. I don't even know
fire
what that means.
emoji.
They took down the entire Fontainebleau Hotel. By the way, I encourage folks to go down there just to see the lobby and the foyer, because there must be 30 pictures of Frank Sinatra and his crew back in the day. I could have spent 4 hours looking at those pictures. Quite frankly, I probably did in aggregate. But it was a great conference. By the way, on the other side of the break, Danny Moses, Steve Eisman, Vincent Daniel, and Porter Collins were on stage at iConnections, interviewed by the great Melissa Lee. That will be the B block, the B side, as if it were.
Stick around for that. That was, and Danny, we got to talk a little bit about some of your impressions. This is the first time I think your crew from The Big Short were together easily on stage. You also were on CNBC's Fast Money on Tuesday. We'll put that clip in the show notes because there was some pretty classic stuff that I don't think has been said on CNBC's Fast Money in a very long time. Danny, talk to us a little. What was that like, getting your crew together? Maybe give a quick recap about how you guys made it into Michael Lewis's book, The Big Short, that became Adam McKay's phenomenal movie, The Big Short, and why has it been so long that you guys have been together on stage?
Keep in mind that Meredith Whitney and Vincent worked for Steve as his analysts back in 96, 97, 98 timeframe. That's when I started at Oppenheimer on the sales desk. And so Steve was the analyst and Vinny and Meredith worked for him. And that was subprime auto crisis #1 in 1998. So we had seen an iteration together. Fast forward, us all working together at Front Point in 2006. We stayed in touch with Meredith, obviously, through that time period. And during that time period where Michael Lewis, or during the financial crisis, Michael Lewis was looking for people to talk to, he reached out to Meredith Whitney and he said, "Who should I talk to?" And she goes, "Well, I have the team that you should talk to about what's going on." We got connected to Michael Lewis through Meredith Whitney. So, 2 degrees of separation there. After Front Point kind of dissolved in 2011, Vinny, Porter, and I went to Seawolf Capital. Steve started his macro fund, Emrys. And we did that for, 5 years or so, the first iteration of Seawolf, and Steve did Emrys. And then Steve ended up at Neuberger Berman. And now, funny enough, and then I'll talk about this in a second, really now focuses on kind of a long only portfolio. So while he certainly taught the skills, has the skills to short everything and anything that he wants to, he's geared himself towards being long. And that was the funny part of the conference, was how relaxed he was. And I'll get into that obviously later in the show. But, Vinny and Porter have been basically managing Seawolf now for several years as a family office. And so they've been back involved in the markets. But what's interesting about this conference, and everybody's used to hearing us talk about financials, is that Steve was talking about infrastructure and Vinny and Porter were talking about energy. And so there are a lot of other ththings to kind of focus on. We can get into all of that. But yeah, that was the first time physically the four of us have been all together had to be 10 years. We've seen each other one-offs separately, but so, yeah.
It was must-watch. That conference room, which was a large room at the Fontainebleau. Standing room only. They call that SRO. And there were many of the panels that had large audiences. I'll put your guys up there against anyone. So stick around for that, because it was worth the price of admission, number one. Number two, Danny Moses. I'm going to take you back to 1984. I was either a sophomore or a junior in college-ish, depending on, when that 1984 sort of was in the calendar.
Sure.
But there was an artist that sort of took the world by storm, and I'm not going to ask you to guess what's in my head, like an Oz Perlman type of thing. But what I'll tell you is, if you read her name, you wouldn't pronounce it the way it's spelled. Now, Sade, spelled S-A-D-E, Your Love is King, Danny, was one of her many hits. But the song that resonated with me this week was Smooth Operator. One, because Ron Biscardi is one smooth operator. I mean, what he and his team were able to pull off down there is nothing short of miraculous when you think of all the moving parts. But then the other smooth operator this week came in the form of Jerome Powell, who gets there and does a little smooth operator stuff. So I'm thinking the title of this podcast is, in fact, Markets and Their Smooth Operators. But, Danny, talk to me about sort of Ron and what you learned from that. And then let's dovetail into the Fed and what you gleaned from that.
He's a smooth operator.
See that? I knew you had
I love
it.
Sade. Couple of takeaways from the conference. My highlight was the David Zervos, Mike Wilson panel that our own EY from SoFi hosted, I must say. Zervos walks in the day before the Fed in, I don't know what outfit that was exactly, but the hat was a crown with a P on it. And he wanted to explain that was for Jerome Powell, who is the king, and the king of the soft landing, the king Fed has your back. And remember, Zervos did work at the Fed, I think in the late 2000s. So he had some experience there. But the takeaway from that was that the Fed has your back, that no matter what happens, you have to believe that, QT is going to come to an end here in March, that if there's a commercial real estate problem, which we can talk about, they're going to solve it. If there's a TALF, if they need to do TALF 2.0, they'll do it. They have your back. And that was kind of the theme. And Mike Wilson was there. And I'll tell you, Mike Wilson made a great point. Mike Wilson said, when you think about the markets, you got to think of public equities, which is what you can really trade in privates. And the point he made, which I hadn't really thought about, is how much the private capital has dried up. And so if you want to talk about those in aggregate, and not to be bearish or bullish, you talk about the lack of capital, how many companies are going out of business daily as a result of not getting access to private capital. I thought that was an interesting point because we can all talk about private capital marks in general, kind of what those look like. So that was a big takeaway there. And, some of the other presentations, Barry Sternlicht mentioned right before this, we had the CRE news by 4 different companies basically come out that he thought you could have 1.2 trillion in losses in the office property market, which is a $3 trillion market. And again, these are things that have been delayed and pushed out, and they're now front and center again. So those are kind of my big takeaways from the conference. But I was quite a collection of people. And not every time I have to go to these things, but when I go to these things, I have to bob and weave because there are people from my every walk of life that I've had on Wall Street. Some you want to see, some you don't want to see, but it was a great time with you guys.
Well, you were obviously a rock star down there. By the way, go to our YouTube channel, the Risk Reversal YouTube channel, because we have the Zervos Wilson panel moderated by EY from SoFi on that. It was excellent, Dan Nathan.
Yeah, we actually, this is a great time to plug all of that stuff. You and I did a market call with Jim Chanos. That was a great conversation. His insights were awesome. I did a panel on stage with Alexis Ohanian of 776. That is a VC firm. He's also one of the founders of Reddit. And Rick Heitzman, our good friend, the founder CEO of First Mark Capital. Guy and I were also on a panel with Jason Calacanis from the All In podcast and our good friend Ted Seides of Capital Allocators. We talked about the business of podcasting and investing and the like. So we got a ton of stuff on there. So be sure to check all of it out and follow that page.
No doubt. They're very digestible without question. You should check. Listen, you go to these conferences, a lot of people, before we sort of dovetail into other things, think these things are complete boondoggles. They're not. You can learn a lot if you just talk to people, sit on these panels, and listen and pay attention. Yeah. The cheapest thing you can do, Dan Nathan.
Yeah, I mean, listen, we talk about that term sentiment all the time in markets, and so it's not too often, Danny, and you made the point about like what you make yourself do when you go to these things. I mean, what was interesting is that there were over 4,000 people from all over the world there, from across all different asset classes, right, with a focus on alternatives too. But everyone has this backdrop of the interest rate environment, both here and the kind of divergences between other regions, and then how money is being moved around into different asset classes, and of course the stock market, right? And so we had a couple great guests on Fast Money. We had Drew McKnight, one of the CEOs of Fortress. We were talking about private credit. We had Blythe Masters, who's also in alternatives. We had crypto conversations. So just to gauge how people are thinking about the existing environment, how geeked up they are about it, how bearish they might be in spite of what's going on, I thought it was amazing. I mean, my one takeaway, though, Danny, and I think Porter and Vinny made this point on the panel, and definitely you're going to want to listen to what they have to say about it. It seems that people are pretty excited about the existing investment environment, Danny, which seems to be almost at odds as the way people came into last year, 2023.
I think they're excited because the irony is that, and I think Vinny said this on Fast Money, that people are too complacent. So that creates opportunity on both sides. And I think the area that Vinny and Porter focus in on their kind of long portfolio are kind of names that are off the beaten track, value names that don't get a lot of eyes on it. So if you're lazy in this market and just want to just go with the flow and you're not worried about it, you're not going to even focus and do the work on those names because you're just going to go buy the big names that are working and have comfort. The flip side of that is you're also not doing any bottom work potentially on shorts because, quote, shorts don't work, but there have been and continues to be stocks that get drilled on a daily basis that if you were doing your work and you were able to kind of project or figure out, what costs were going to start coming up, whether it's credit or labor on some of these companies, UPS, things that have gotten hit here, you can do well in. And so I think the complacency is not just about being bullish. I think it's about just being lazy and figuring you can make money right now in this market. And what happened the day before the market got hammered yesterday, which was the largest drop since September, the bull bear index was the highest divergence it's been, I think, on record. So again, watching sentiment, feeling sentiment in there, that's not to say we're going to have a massive sell-off. You're right, Dan. People are looking for an excuse, and they're kind of ignoring the elephant in the room that I know we're going to get into right now in commercial real estate that will be with us for a long time and maybe just packaged into some small banks and regionals and stuff like that.
I love elephants in rooms, so I'll bring that one up right now. We saw on Wednesday of this week, New York Community Bank cascade lower on the back of what apparently is New York Community Bank specific. I'm not convinced that's the case. I think in this instance it is, but that's not to say that other banks don't have similar loans out there that at some point are going to sort of manifest their way into the stock market as well. But as you mentioned earlier, Barry Sternlicht talked about that on his panel, happened this week. You see what appears to be, again, sort of idiosyncratic to New York Community Bank. However, it was dragging down, obviously, the KRE and other things, Danny Moses. It's amazing how, this started in, I guess, March of last year is when we started to hear about Silicon Valley Bank. So less than a year later, some of the same type of issues are manifesting.
So, but Danny, and I guess this is a question for you. When you think about what was the reason that, the Fed and the Treasury and everyone had to come in and backstop deposits and it was a run on these banks. There was a lot of companies that would have gone under, right? Silicon Valley in particular. There was a particular concentration between the banks that ultimately got backstopped or went under or were placed in the arms of somebody else. These smaller now community banks, they have some bad loans, right? But they're not going to have the sort of systemic risk that might have happened if, hundreds or thousands of startup companies that had all of their capital and all the VCs that had all of their capital in SVB and the like. You know what I mean? So I'm just curious, does it make sense to kind of differentiate a little bit? I'm not saying that it's contained. I'm just saying that it looks very different.
Yeah, it's a great point. So in the case of New York Community Bank, before they bought Signature Bank, and let's keep in mind they bought a bunch of those assets, and that's part of the problem here, they're really focused in multifamily and in New York City. And with the rent control issues in New York City, they were already under the radar, or I should say under the microscope for how they were going to do this. Because if the cost to finance went up and they were unable to raise the rents, you guys can do the math. So that was an issue with them from the beginning. Buying the Signature Bank and bringing it in, there was two bad loans here that they're talking about. So it is company specific. It is loan specific. We've seen that, we saw that out of Blackstone as well, kind of a loan specific thing that happened. So that's okay. I think the way they handled it was horrendous. I think the fact that everyone knew when they acquired Signature, they made an acquisition prior to that as well, that they would exceed $100 billion in assets. That comes with more restrictions, more compliance things that they have to do. Why would you wait till now to come out all of a sudden? I think it took people off guard. They cut their dividend massively. That obviously gets hit. So I'm not saying it's a buying opportunity by any means, but it did bring back kind of post-traumatic stress from last March. That was one. The other things that have happened was that Azora Bank in Japan, right, which is not a huge bank. I think it's equivalent of a $2 billion market cap. It's the 16th largest bank there, though. I'll take its second most heavily shorted name on the Nikkei, just by, it's down, lock limit down 20% on losses of $200 million and another reserve of $200 million on U.S. office properties. Julius Baer, which is a private bank in Switzerland, ousted the chief executive based upon a $700 million write-down in Australia. And Deutsche Bank increased their loan loss provision fivefold in office in CRE. So these are things that are happening. And are they all those siloed a little bit? Sure. But it brings back to the forefront the issues. And just know that the Fed has been sending out letters to these smaller banks that you've never heard of continuously since last year. So they're watching certain banks. So I think it will fuel more M&A, not necessarily for New York Community Bank, but in general. But I think if you're a small bank right now, you also realize you're having board meetings right now to talk about some of your exposures, making sure you're buttoned up for sure.
Yeah, no, look, M&A might absolutely happen, but they might also be in the form of take-unders, not take-overs, as they say back in the day. So we'll see how that plays itself out. But I think one of the reasons as we sit here today on Thursday into Apple earnings tonight that we saw 10-year yields go from 420 almost over the last week or so down to 381, which is, again, a staggering move, Danny Moses, is on the back of this and some other things as well. And that yield curve inversion, which I think got down to 14 or so basis points, gets right back north of 30 basis points. I will tell you, Danny, I can't figure out what it all means. Carter Worth has talked about this, and he's been right, by the way, in terms of yields. He thought there was a point where lower yields would actually be deleterious to the broader market. You know, maybe we're starting to see that around the edges, but what does this bond move mean to you, if anything?
1967. Guy, 1967.
Taking me back.
The band Buffalo Springfield.
Sure.
What was the song?
For What It's Worth.
That's right. There's something happening here.
You see, we didn't
All right,
rehearse this. Dan Nathan just looked at me.
That's the title, though. You got blown out of the water.
No, we can listen.
Yeah.
That's why we do these things. For what it's worth, there's something
happening
here. What it is ain't exactly clear. Thank you, Danny Moses.
There's a man with a gun over there.
I'm picking up on my guy Adami's. So let's go to the Fed meeting yesterday. And around the Fed meeting was the ADP number. I know we're sitting here recording ahead of massive tech earnings and the jobs report. So I don't know, what we're going to say here will be pertinent or not. But around the Fed meeting were some bad economic data, and again today in terms of jobless claims and challenger job cuts and so forth. So I looked at the Fed fund futures obviously before we came on, and yes, of course, March has dropped to near 40% chance. But guess what hasn't dropped? Chances of 6 cuts, just back and loaded at the end of the year. And so he can talk all he wants. And I think the takeaway is that once he starts cutting, he's going to keep going. So whether it's March or whether it's May or whenever it's, that's my takeaway. And to follow through, Guy, to your point about rates, obviously the 2-year yields are going to track kind of more of the Fed, but the 10-year yields, what is that saying? What is that telling us, right? It's telling us that people are expecting certainly inflation to cool, but maybe things to slow down. This is not a bearish or bullish comment. And I think that people obviously got over their skis a little bit. I know you guys had Carter on for a great market call today, and Carter had called this retreat in the 10-year yield. And maybe it's just a trading play at all. But I think when you start seeing the 10-year yields coming in conjunction with the market not going up today, obviously the market's rising today and 10 yields are coming in. When you start to see the pairing of lower yields with a lower stock market, I think that's when you have entered the danger zone potentially, in my opinion.
Yeah, and I guess the problem is, Danny, that we have a stock market that's within 1% or so from an all-time high. And, I just mentioned Drew McKnight from Fortress, so the co-CEO there. We also had on with Drew on Fast Money, if you recall, Guy, on Tuesday afternoon, a gentleman named Armin Panosian, who is the incoming co-CEO at Oaktree. So these are two, fabulously, successful, right, credit funds. And, Armin made this point that they were in, or they have been in this higher for longer camp, that he was saying this on Tuesday. He did not expect a very dovish Fed. So we asked him, what are the conditions in which, right, the Fed would have to stay higher for longer, but also what are the conditions in which, Danny, to your point about what the markets are pricing for rate cuts this year. And, I'm just hard-pressed to see if we have 5 or 6 cuts this year, it won't be for good reasons, right? And you can make the argument that higher for longer, and this is kind of what Fed Chair Powell was saying yesterday in the Q&A, that, there are plenty of good reasons that are keeping them from cutting right now, right? And so I just thought that was a really interesting conversation, and it might be the sort of thing that keeps equities buoyed, I heard Mike Wilson earlier today, and Mike, again, as you just mentioned, and just, I heard Mike Wilson earlier today, I think it was on Bloomberg, highlight the fact that, we're in an environment where real yields are attractive, right, for the first time in a while. So if you're just looking at some of those things about where the 210 spread is, right, and this and that, whatever. So again, I just think this year is going to be really complicated for those who just think it's about rates and rate cuts, if you will, because for some reason, equities are acting in a way, at least the mega caps, that I just can't put my finger on. But to me, me, that's what I see as the biggest risk. Is just this increased concentration in such a small group of stocks.
Danny mentioned jobs, and I think, look, the market is predicated on a lot of different things, but I think, and I've thought this for a while incorrectly, that the unemployment rate was going to start to move dramatically higher. Now, just let me point out that Danny mentioned Peter Bookvar's work and some of the numbers that came out. But just think about anecdotally what we saw. So I'm going to take you back, Danny, to August of last year, and that's when UPS drivers basically agreed with UPS. The average pay was going to be at $170,000 at the end of a 5-year deal. And you saw that, and good for the drivers, good for UPS. And I remember saying at the time, be careful what you wish for, drivers, because you know what's going to happen on the back end of that? You're going to start to see layoffs. And that's exactly what we saw earlier this week. And UPS, the stock, has not performed well at all. Now, that is anecdotal, I know, but not really, Dan, because we have seen a swath of different industries over the last year or so announce layoffs. Now, it has not made its way into the unemployment rate. I don't know how all those things are devised. I think a lot of it has to do with government jobs, which have been on the rise in a marked way, I think, to keep the unemployment rate lower. But in my mind, it's just a matter of time before you start to see that. And when you start to see that, that's going to have ramifications.
All right, so that's a great example, and I'm glad you brought the UPS thing. And UPS has not seen an uptick, all week long for the most part, even after all of those job cuts. Here's another one that had a really bad week. This is PayPal, So they announced 9% workforce reduction. That's 2,500 jobs. This is a company that has a new CEO and hosted an AI day, last week that fell flat. Here's a company that was supposed to be on the forefront of fintech innovation for years. We know that this stock is down, 80-some% from its 2021 highs. It trades at a perfectly fine multiple. It has, a perfectly fine business here. It's got a perfectly fine balance sheet or whatever. And so my only point is that, when you see those sorts of job cuts and then you see the sort of expected innovation fall flat, the stock was down 4 or 5% the day after their big AI innovation day. And so my point is, this might be a trend that we continue to see throughout this year. If the markets are not going to be rewarding companies who are not able to seize on this technology, they're going to be forced to aggressively cut costs. And obviously headcount, Danny, is the first way to do that.
But listen, most of the kind of top 6 tech names, Tesla's not one of them, we'll talk about that in a minute, are, certainly stocks are doing well, but most of them are cutting jobs. And we've gone into this secular kind of growth story in semiconductors and AI and all that. I get it. But growth companies don't cut a lot of jobs. Now, that not being said, you can cut jobs and become more efficient and certainly dedicate more resources to your technology, not your human resource. But I think the theme we talked about, kind of going into this year was going to be labor. Not just people getting fired, but labor costs moving up. So if you're going to keep your employees, you're probably paying them more, so it's a hit to your margin. And if you're going to lay people off, that's obviously a hit to the economy. And certainly you can help companies. So again, every company is very different, and you better know what you own. But I think we're going to see this theme. And listen, there are layoffs being announced every day. And I just mentioned before that on the Challenger number that Peter Bookvar was talking about today, I think that there was the highest January job cut. Obviously, it was fins and tech, since January 2009, I think, for a month of January. So I think it's wake up time for that. And listen, unemployment, I think tomorrow when it comes out, it's supposed to be 3.8%. I mean, but directionally is, I think, what we look at. And I'm going to make one more comment. Think about Powell, how late he was, obviously, to his transitory call. And he obviously wants to make this right. Let's think about the possibility that when he does finally cut rates, it might be 50 at one point, not 25. Right. Just put that in your head, because that would explain the how many meetings will be left in the year, yet the forecasts implying 6 cuts, right? So just think about that.
And I don't know what I'll be honest with you at this point. I think most people would say if that were to happen, that would be extraordinarily bullish for the market. And I understand at a very one-dimensional level that probably makes sense. Other people might say, or the market might actually say, my God, what's going on here? Why are you cutting 50? I mean, what do you see that the rest of us don't see? So we'll see. But in terms of jobs, Dan, before I throw it over to you, I'm telling you, when you have an economy that is predicated on people buying things, 68 to 70% of the economy is driven by consumer spending. Consumers spend when they have jobs and when they feel good about things. I get it. Stock market goes up. People see, you know what? The economy must be great. I'm going to go out and take that trip, buy that Starbucks, all those different things. It feeds on itself. But if that unemployment rate starts ticking up, as it probably should, just given all the things we've seen over the year, people are going to start to take notice. Consumer spending starts to ratchet down, especially now when you're talking about credit card rates on average at 21.47%. Think about that for a second. So, again, I'm not trying to sound all dour here. I'm just trying to sort of read the tea leaves.
Yeah, there was, and we mentioned this on Market Call earlier, there was a note in Axios earlier today, the one big thing, the puzzle keeping the Fed hesitant. And again, and I think you make a really good point, the whole idea that, what's been priced in 5 or 6 as far as the market, and then what the dots are saying in this and that, whatever, there could be a surprise cut of 50 basis points. And then, think about the way they were raising at 50, 75 basis points a clip for a while. But this was a really interesting point. It kind of caught my attention. This was, America appears to be in the midst of a productivity boom, the likes of which we haven't seen in years. It's allowed inflation to keep coming down alongside rapid growth, solid wage gains, and thriving labor market. But Powell appears to be skeptical that those productivity gains will be sustained, a big risk to what has been so far an economic success story. So I just thought that was a really interesting framing of the thing that's keeping some folks like us on the sidelines before we're going all in on this sort of thing. And the thing that would maybe cause him, if we were to see some of those pieces of that Goldilocks puzzle there, Guy, to come untethered a little bit.
Well, I mean, look, right now, it absolutely has been Goldilocks. I mean, without question. I mean, if you think about all the data we've gotten, the economy is still humming along in the form of GDP. Unemployment is still sort of below that sort of markedly below that 4% sort of threshold I think people look at. On the flip side of that coin, consumer spending's been good. Consumer sentiment's been very good. The inflation rate is still growing, but obviously growing far less than it was a year and a half or 2 years ago. So they're seemingly getting that under control. The stock market obviously loves all this stuff. All the puzzle pieces are falling into place. Of course, there's still so many things to see in terms of what we just spent the last 20 minutes or so to talk about. I am not convinced this entire sort of book is over by any stretch of the imagination.
So, Guy, this brings me, and Danny, I've got to get your take on this. Okay, so Carl Quintanilla, CQ, we'll put it in the show notes here. He tweeted out this morning this quote from Apollo. 89% of U.S. household debt is fixed rate. As a result, the transmission mechanism of monetary policy has been weak. Fed hikes have had a limited impact on the consumer. Now, this is Torsten Slok, and this is something he said on Fast Money with us. Steve Eisman has also said this on Fast Money with us. Danny, talk to us about this because, again, the long and variable lags of this monetary policy, it has not been affected. It has not affected the consumer the way I think you and I and Guy would have thought a year ago.
Well, it has in one way. So the lower end consumer is getting impacted. That stat you're talking about, I think north of 70% of that's related to mortgages. Another 7 or 8% is auto. But think about the people that don't own homes, the ones you saw Discover's earnings, right? A week ago or two weeks ago or so, we talk about that's the lower end consumer that's starting to get hit. And so it continues to be a story of the haves and have-nots. When Ivy Zellman came on a couple of weeks ago, she made it clear that this cycle is unlike any other because after the global financial crisis and these mortgage products kind of went away, these 2 and 3 year ARMs, most people termed out most of their mortgage. So the flip side of that, Dan, is they're not getting hit as much as they would be as a homeowner. But the other side of that is when the Fed actually starts to cut, they don't get the benefit of it. So I think historically the knee-jerk reaction, and maybe you get oversold when rates move higher because it doesn't have as much of an impact, to your point, on consumer spending, and you're not going to get the rebound. But I would hearken again, and I would talk one more just to close out the economic stuff, that the lower-end consumer is getting hit. The lower consumer continues to get hit. And everyone at that conference, even Steve, who's certainly a little bit more bullish than he had been in the past, is focused on, I'm not concerned unless the unemployment rate moves higher. But let me just say this. The average unemployment rate through history, I think, is around 5 to 5.5%, right? So we're still sitting down at this 3.8. I'm not saying it's going to get there, but we know how this market overreacts. And you start to get a 4.1 or a 4.3 or 4.5 direction, we know the crying is going to be, out here for the Fed. So, Dan, I just think it's a tale of two consumers in that sense of who's impacted and who's not. But it's a great stat because, again, it hasn't been as impactful as you would think it would have been.
Well, before we go to big cap tech, I'll say this. The way they being the Federal Reserve, thinks they can control the unemployment rate is the same way they thought they could control the inflation rate, which is to say they can't whatsoever. Obviously, this week has been dominated by big cap tech. We're doing this on Thursday. I want to be clear. So we're not going to talk about Apple in terms of their release, Amazon in terms of their release, because we haven't seen it yet. With that said, Dan, we did hear from a few companies on Tuesday that I thought were really fascinating reports. I'll start it off real quick and say AMD, which was a fine quarter, their guidance concerned me a little bit. It concerned me because, A, given their growth trajectory, I thought the guide should have been much better than it was. They actually guided down for revenues. And B, you're talking about a stock that is effectively doubled since their last earnings release. So a lot of good news was obviously anticipated into the quarter. I don't think the market got it. Now, with that said, the stock sold off, but not in a meaningful way at all.
Yeah, well, I'll just say this because this is going to get you guys all tuned up. I mean, AMD, at least for their fiscal 2024 guidance, I mean, it is back-end loaded here, people. So all the excitement about their GPUs that they're going to be competing with, right, with NVIDIA and all that demand that we believe that's out there for them, is going to come in the second half of the year. And so to your point, Guy, when you see the sort of guidance that they guide down in the near term, you know, it's not particularly exciting. This year, we're supposed to see 15% revenue growth. You know, NVIDIA gained $1 trillion in market cap last year, not because they were growing 15%. They were growing some quarters 80%, okay? Like they had the chips, they had the orders, they have the quality, they have the market share, they have, you know, so, and they were able to navigate all the headwinds that they had about selling into China and the like here. So the AMD story with the stock up nearly 100% in the last 5 months or so is just not the story of NVIDIA in 2023. I mean, like, to me at all. And I just want to make one last point on the semis. While Taiwan Semi had a big day, and given their guidance that they gave, I think about 2 weeks ago, Intel did not trade well after their guidance. You know, Qualcomm, a company that I was trying to get my arms around and kind of think about what is the opportunity if we do see handset demand bottoming and maybe re-accelerating, down 5% as we speak right now. So some of these like second tier sort of stories that people thought they could kind of, you know, just kind of pick up, you know, kind of, what do they say that? Pick up nickels
on the subway tracks.
Yeah, they're kind of getting clipped here a little bit.
Well, without question. And again, big cap tech is obviously driving.
Well, hold on. The other one we got to talk about is Google.
Yeah,
Here,
well, I was going to say.
2 quarters in a row,
down
9%. Digital ad sales, okay, that was last quarter. Digital ad sales weak this quarter. The stock hasn't seen an uptick in 3 trading days.
So go back to October of last year. I think Google was trading around 140-ish. They reported their quarter. Within a day or 2 trading days, was trading down to 122 or thereabouts. So you're seeing a very similar type of response on the back of this quarter. Now, obviously, the stock got back on its horse like everything else, and it rallied into year-end into this earnings release. But that is something absolutely to look at because, again, it's if you think about the medium and small businesses, which probably a lion's share of a lot of this ad spend, you start to connect the dots here and you say, wait a second, maybe things aren't as rosy as they appear.
Well, not only that. I mean, listen, here's a company that consensus has 61.5% gross margins this year. That's down from nearly 68% last year. So if they're having headwinds to their digital ads, okay, if their cloud is not growing as fast as people expect because they don't have the Gen AI products in there causing greater demand, and the spend is higher for all the GPUs and the servers and the data centers or whatever, then, you know, we can sit here and say, well, at 21 times, it's a cheap stock relative to some of its peers. Not if those margins are not expected to go up. And I'm looking at consensus for 25 and 26, and their margins are also expected to be below 62%.
Danny, if I were your caddy, in other words, if we golfed, I wouldn't golf with you because I don't golf, but I would walk with you. I'd carry your bag, and I'm sure there'd be times where you're a little tired, so I would actually get a tee out of my pocket and tee up a ball for you. So that's what I'm going to do right now. We've seen yields move dramatically lower. We've seen the dollar come off on the back of it, but we've no seen gone higher in a very clandestine way. That would be the gold market. And gold has, look, it is really not backed off at all. And we're within, again, earshot of making, you know, another all-time high. Is gold telling you anything? It certainly is telling me something.
Big tell yesterday at the Fed meeting for sure. You got what was perceived as hawkish. Gold sold off for a few minutes and then re-accelerated back up. Again, I point to the longer end of the Fed fund futures curve for that reason. As a matter of fact, there's ceasefire talk in Gaza right now. The oil prices are obviously getting hit here, and you're seeing a little bit of a market rally. Gold's not selling off. You would think gold would sell off if that were to happen. So Yeah, it certainly feels like it's in very strong hands right now, Guy. And so I still like it. And I think that's where you're going to want to be, especially if you believe that the Fed's going to start cutting rates.
Yeah, I'm glad you brought up energy because obviously you're right. We've seen, as we're sitting here, crude oil come off in a pretty meaningful way on the back of what you just highlighted. I think one of the reasons the market is rallying is on the back of that. We'll see how that plays itself out. With that said, I will tell you, Danny, there have been some oil equities that have done extraordinarily well, sort of these levered names that we talk about from time to time, PSX, Marathon Petroleum, MPC. All these stocks are within earshot, if not making all-time highs. And in my opinion, Dan, it's just a matter of time. I know you probably have a counter view, but I think some of these big cap integrated names are going to pick up as well.
Listen, the names that you've been highlighting, like the PSX and the MPCs, those stocks have acted phenomenally. Now, we've obviously talked about these large integrators. There's like $200 billion of announced deals that I think are kind of keeping those stocks suppressed. But I just highlight this. I mean, the drillers don't act well. You know what I mean? You saw Schlumberger and its response to its results this week. I just think, listen, if crude oil can't get out of its own way, I just don't think like I'm going to be piling into integrated oil stocks anytime soon.
Dan, your point is absolutely fair. I mean, ExxonMobil, Chevron, ConocoPhillips have not traded well. The news out of Schlumberger or now SLB Corp, not good at all, without question. I'm still here to tell you, I get that funny feeling that there's some more chapters left in this energy story, but we'll see. Gold story's manifesting itself, yields lower, dollar lower, S&P higher, all a lot of things. But when we come back, that panel at iConnections, moderated by Melissa Lee, Danny Moses, Steve Eisman, Vincent Daniel, and Porter Collins, stick around. It's worth the wait.